Yes, sir. Thank you, Matt. So Jedi Options, we've been gushing on gold, not because we're biased, but because we follow the price action. And you cannot deny that you're seeing inflows into gold and gold stocks. So I'm going to use GDX as the focus here. This is the gold miner ETF. And the title for this Jedi Options is going to be let's go bull call spreads. Okay. And I'm going to tweak it and show you how to make it more aggressive versus less aggressive. But let me back up a step. When you take a look at GDX here, this is it's a breakout. It's a breakout because it hit resistance $30. One, two, three, four, five times. Then today you finally clear it, right? And technical analysis, kind of the price action theory says when you hit a level, you hit a level, you hit a level, you hit a level, and then you break through that level. Well, the assumption is that you are more likely to go higher at that point, right? Because you've finally taken out all those sellers. Path of least resistance is higher. And it's not just this one breakout over 30. It's also the overall trend. The primary trend is up right now. The 50 is rising, the 20, the 9. It doesn't mean GDX goes straight up. It does mean, as we said earlier, it's impossible to be bearish on this if you care at all about the technicals. So how do you play it? Number one, you can always buy the stock. You can always buy the equity. And the good thing about that in this particular case is that even if it takes a nap and it goes sideways for 2 weeks and then goes higher, you don't get hurt by the time decay, right? So as opposed to buying a call option where you're like, hey, not only am I betting this is going to go up, but I'm betting it's going to go up like fast. I want it to go up quick. That's what you want when you buy calls. With long stock, it's like, listen, I want you to go up. I'd like you to go up quick, but if you don't, it's not the worst thing in the world. I got time. I'm going to park the money in there for a while anyway. So if you want to go higher in a week or 2 weeks, that's fine. But you're bullish. Your bias here is bullish. So I want to walk through like the options side. And usually when we talk about strategy selection, it's like, well, you can be aggressive and go with strategy X, or you can be a little more conservative and go with strategy Y. What I'd like to do that's different, that'll make this video a little more unique, is I want to do one strategy, but shift it and give you a bullish variation and a slightly less bullish variation. This is the beautiful thing about options. Options give you options. You have so much flexibility. And again, part of the reason is because you have different strategies. But the other reason is because with the same exact strategy, you can skew it more bullish, more aggressive, or more conservative. And part of the reasoning maybe why you would be a little more conservative, number one, I know it looks like GDX is never going to go down again, but this is up 4% today. It was up 4% yesterday. If you look at this in the last 2 days, it's up like 8%. And at the same time, when you look at the weekly chart, you have a 200 weekly moving average looming overhead that could maybe bring in some sellers and cause this to need to pause for a minute, right? So it's kind of like, listen, I want to get my foot in the door and have some exposure, but maybe I want to do it less aggressive just in case it pauses or pulls back or whatever. So the basic structure of a bull call spread is you buy a lower strike call option and you sell a higher strike call option. And there's different guidelines and variations based on who teaches it to you. But fundamentally, if you buy a lower strike call and sell a higher strike call in the same month, the same expiration cycle, it's a bull call spread. And then you can skew it more aggressive or less aggressive just by changing the strikes. So the strike selection is kind of everything. The strike selection is everything. You can create a bull call spread where you can make a 1,000% return, okay? But there's going to be like no chance that you'll get that. You can make a bull call spread where you can make a 10% return with a very high probability. So the probability versus the payoff, you can structure it any way you want with a bull call. You just have to learn how to do it by putting the strikes higher or lower. So what I want to do with GDX is just show you 2 examples and see how that plays out in the chart. Most of the time, the default, we would say, well, a simple bull call is maybe you buy an at the money call. The stock's around 31, so I could buy a 31 call. And then you sell a higher strike call against that. Okay. Now, I think a $5 spread is unnecessary because a $5 move in GDX is a big move. It's 5 ATRs. This moves about $1 a day. A little bit more, I think, logical would be like a $3 or $4 spread. Okay. And let me do, I actually got to look at the numbers. I don't know which one I want to do, but let's go to the trade tab. I'm going to push this out, and you could do Feb. I'm going to do Feb. I'm going to do Feb here. 44 days. So I'm going to buy the 31 call. And part of the reason I wanted to look is I wanted to see kind of what the deltas are as to whether I wanted to go $4 or $3 wide. I think we could do a $4 wide. 31.35. It's a 20 delta. It's a $4 wide spread for $1.20. This would be the aggressive variation. You're paying $1.20. You can make $2.80 because it's a $4 spread, but you need it to get to 35. There's about a 20% chance you're going to get your max reward at expiration. If you do the math, you're risking 120. Let's see. I can make what did I say? 280 on 120. You can make about a 233% return if GDX gets to 35. Okay. Now that's a bit of a stretch, right? I mean, 35. It's going to be a nice push higher over the next 6 weeks, but I don't think it's completely unrealistic. Now it doesn't have to get to 35. It could get to 33 or 34, and you're still making a good amount of money. Okay. That would be, I think, a decent way of playing this, right? If you're bullish on gold and you think the goodness continues for the next 6 weeks, that's a good little trade there. Instead of me saying, okay, the conservative alternative is go sell some puts or some bull puts, which is definitely true, I could just stick with the bull call. And all I'm going to do here is just lower the strikes. And as you lower the strikes, it increases the probability, which in turn is going to decrease the potential return. It's fair. It's just, that's the way it works. Okay. So instead of buying a 31 call, maybe I buy a 28 call. And to make it the same spread width, so it's apples to apples, I'm going to sell the 32. That's a $4 spread, and it's going to cost more. Okay. Which means my potential profit is less. But to make the money, I only need GDX to get above the 32 strike. It's almost there already. I'm almost at the max profit zone with this more conservative bull call. And so I'm not going to make as much. It's a $4 spread. I'm paying $237. So I can make $163. If you divide that by the cost, it's about a 68% return. I know I'm throwing a lot of numbers at you, but conceptually, this new spread, paying $237, okay, I can make a 68% return, and I got about a 42% chance of making that money. The other one, I'm paying $1.20. I can make about a 233% return, but I only have about a 20% chance because we got to get to 35. Both of them are bullish. Both of them are legitimate ways of playing this breakout in GDX. I either do the 31.35 bull call or maybe the 28.32. Both of those are legitimate trades. You can see this one's more aggressive because you need to get above 35. This one's more conservative. You only need to get above 32. But listen, 68% return, that's fantastic. 233% return, that's fantastic. They're both more aggressive trades than if you were doing a covered call or a naked put or a bull put. But I've just shifted it slightly. Okay. So there you go. Having fun with bull call spreads. You're in control. You pick the strikes, and it in turn influences the payout, the probability, the risk, and all the rest.